Welcome to Warrior Startup. I am your investor Sherpa, and on this channel we go over everything from how to build your company out of a napkin sketch to landing that 6 to 7 figure investment from investors such as myself. And on this video we're going to cover how to value your company for an investment or an exit, and please consider subscribing to get the latest videos on improving your startup. If you're looking for investors or are ready to sell your business, you need to determine its value. And you might have been in business for 20 years without ever having to do it, or maybe you've only been up and running for 6 weeks. At some point, you'll likely find a need to place a cash value on your company. Yet, it's unlikely you are a financial expert, so how do you figure out what your business is worth? There are several ways to determine the value of your business. The two most common methods are the multiples method, also known as the comp method, which is really the simplest, and the other is what's called the discounted cash flow method, or DCF, which is more complicated, and I recommend at least attempting both. The first method requires you to apply the multiple of revenue of EBITDA, and that's earnings before interest, taxes, depreciation, and amortization, at which companies like yours have been sold, and then multiplying it to your latest EBITDA or revenue. And the discounted cash flow requires you to forecast your earnings into the future, normally 5 years, and then calculate a net present value. So with all that in mind, here are the 5 steps to calculate your business's value. Step 1, forget about capital assets when valuing your business. And unless you're a qualified chartered accountant or financial wizard, you may have made common mistakes of associating asset value with your business value. And in fact, these are two entities that are completely separate. So here's a common misconception. Suppose your business has an office block worth $500,000, supplies and products worth $100,000, financial backing of $200,000, and a fleet of trucks worth $85,000. In total, you have $885,000 in capital assets. So if you were able to sell everything right now, that is the cash value you'd receive from selling. So that is what your business is worth. Now, while all of that information may be true, it isn't what is meant by business valuation. It's not what your business is worth. That is how much cash is tied up in your business. And a buyer isn't interested in how much money they can make if they sell your office block. They're more interested in how much money they can earn through your products and services that you've produced there. That leads to step 2, work out profitability by being aware of gross income and all of the outgoing payments. If the value of your business isn't measured in capital assets, then what is it measured in? Profits. So evaluation of your company is all about the money that you're making and all the money that you're likely to make in the future. So a buyer wants to know how much money can they expect to make if they take over your company. Well, that is where you use what are called multiples. Multiples are longevity meters, so you don't expect your company to go out of business in a year if it's worth selling. So how long is it likely to keep going and earning investors or new owners their money? In a small business world, multipliers or multiples range from 2 to 10. And this number depends entirely on the risk factor involved with the size of the business. Larger corporations with solid foundations and longevity, estimated in the decades or centuries, are likely to achieve high multipliers, but for your common variety, small, medium enterprises are basically a multiple between 2 and 10, and this is pretty much the accepted norm. So you multiply your net profits by whichever multiple is reasonable for your company. That leads us to profitability adjustments. A company is unlikely to generate the exact same profit year after year, so when valuing your business, you must determine the amount of growth or profit loss that you could expect over your applied multiple. Put another way by Abir Sayed from Upcounting, if you haven't been keeping good financial records for historical data, that can take some time to put together and is often a starting point. But if you have the historical data, then oftentimes you can have a financial model put together for small business in about a week or 2. Step number 3, calculate the value. And this is the step that everyone dreads. It's the actual mathematics required to calculate the value of your small business. So first, establish your net income. And to do this, you take your small business gross profit and then subtract all expenses. For example, suppose your business brought in $750,000 with $500,000 in expenses. That's equipment, travel, supplies, salaries, and then we're left with just $250,000. So second, you want to take a look at the multiples. And as mentioned before, the riskier or smaller businesses, the lower the multiple you can expect to achieve. So to work out your unique multiple, you need to expect that there is some sort of guesswork and subjectivity that's involved. So unfortunately, there is no set way of finding a designated multiple. Instead, there are a few basic rules of thumb to follow. And those are research your industry. What multiples have other businesses like yours sold for? How healthy is your business's financials history? Is it stable enough to request a higher multiple? What situation will the business be left in once you depart? Do you have any contracted income guaranteed over the coming years? How expansive is your customer base logistics, and how strong are your supplier relationships. So looking at your variables, you must make a decision based on what you think your multiple should be. So here's a basic guide. A business run by a single worker will be unlikely to sell for a multiple above 3. Businesses with revenue below $500,000 often max out at 5, and then only larger companies earning more than $500,000 in net profits can expect to reach a double-digit multiple. So back to our example, we've got an annual net profit of $250,000. We have $500,000 in expenses, which implies that the reasonable amount of staff. Let's assume then that we fall into the second bracket for this example, so that would be leaving us with a multiple of 2 to 5. Playing the middle ground or so, we'll go with 4, taking us to a current value of about $1 million. Now bump that value up of the business based on potential growth, and it sounds intimidating. However, finding this information is fairly simple, but it will take time and energy to ensure accuracy. You'll need the following information: your own historic growth, or your competitors if you don't have any, your market's growth, and your historic growth is going to be the most impactful factor. It is hard evidence that your business has a track record of growth, and then look at your profits and track how they've changed. So let's keep things simple for our example. So over the past 5 years, our example company has increased profitability by around 8 to 12%. And then we value our business with the additional growth of 10% per year over across the 4x multiple that we selected. So the third figure out of your market significantly affects the profitability in future years to come. For example, if you are in a relatively established and stable market, you probably will be better off using historic figures, as they are more likely to be to have a little movement. And if you're in a new market, you've got an opportunity to increase your numbers considerably. So the fourth is to determine your potential market growth rate. Compare your current growth rate against the market that you're currently in. So say your market grew by 15% last year and your business grew by another 14%. So you now have a reasonable evidence that suggests that the investors and the buyers, that they can expect to see similar levels of growth as those predicted by your industry experts. And while you can evaluate market growth yourself, its potential impact on your company, now is a good time to ask financial experts for assistance, or other business owners in your network for a second opinion. So finally, you want to add growth projections. Going back to our $1 million example, we are in a new market, we are in the accounting industry, and we're going to use historic data to calculate our growth. And that's because accountancy isn't likely to see more growth as a whole than our hypothetical company will. Add 10% per year to the net profits. Remember to multiply incrementally instead of adding 10% to your current figure to ensure accurate numbers. So that would go year 1, $250,000, year 2, $275,000, year 3, $302,000, year 4, $332,000. That leaves us with a total company valuation of $1.1 million. And now $1.1 million is your company valuation. That's what it's worth to investors and buyers, right? Well, that leads us to step 4. So factor in your market valuation. Your valuation is really a guide. So you've created a valuation you can present to investors and buyers, providing them with a reasonable and respectable answer to the questions of what is your business worth. But that doesn't mean your business is actually worth the value that you've put on it. So in the end, your business is worth what the market says it's worth, and market value is often a very accurate way to estimate value, as it is a function of assessment of all the parties and all the information that is available to them. For example, we valued our example business at $1.1 million. Continuing into our scenario, we meet the investors and buyers several times while we cite our valuation figure at $1.1 million. We cannot secure more than $1 million. The investors agree with the valuation to a point, but do they accept the full figure? Because $1 million is now our business value. If you cannot secure the full valuation amount from the buyers, then it is not an acceptable value. The market really dictates the business's overall value, and if investors don't think your business is worth $1.1 million, then the business isn't worth $1.1 million. That leads us to step 5, accept the will of the market. So you may need to compromise on your figures if the market doesn't support them. If you need investment to survive and you can't wait to sell, then you cannot afford to be stubborn with your numbers. A business is really only worth what the market will demand, and if your industry has fallen on hard times due to the coronavirus or As an example, you may value your business at a much higher valuation than the market would. Things like timing and the greater need for your business within the marketplace still matter, even if your brand might be worth a lot more money down the road, or if your accounting records show that you are worth more. Business is really all about leverage. So to cap it off, you often don't get what you deserve, you get what you negotiate. Thank you guys for watching. If you like this video, then you'll probably enjoy these videos on your screen, so make sure to check them out. And again, consider subscribing so that you can get the latest videos on building your startup.